Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report so long it could put you to sleep. Just kidding. We're going to decode the interesting bits of the Blackstone private multi-asset credit and income fund's latest filing because behind all the legal jargon, there are some pretty important things to unpack. So what is this fund all about? Basically, it's a company that invests your money across different types of debt, aiming to give you both regular income and some long-term growth. Think of it as a carefully chosen basket of loans and credit investments with a focus on deals that aren't available to the average investor. The fund's main goals are pretty straightforward: earn income for its investors now and hopefully see some growth in the long run, although income is definitely the priority. To achieve this, they plan to be flexible, shifting investments around as different areas of the credit market become more attractive. It's like a savvy shopper always looking for the best deals. One of their big selling points is the connection to Blackstone, a massive investment firm. They say this gives them an edge, letting them see deals and understand markets better than smaller players. So where exactly is your money going? The fund outlines four main areas. First, private corporate credit, which means loans made directly to companies, not the kind you'd find on the stock exchange. Second, asset-based and real estate credit. These are loans backed by things like buildings, infrastructure projects, or even payments from credit cards. Third, structured credit. Think of this as slices of other debt investments, like those backed by bundles of loans. This gets a little complicated, but the idea is to get exposure to a wider range of assets. Finally, liquid credit. These are more easily traded loans and bonds, the kind you might see getting discussed more often in the financial news. The fund believes this multi-pronged approach lets investors tap into higher quality assets and diversify their income in different market conditions. The fund highlights some of the key strengths that it feels give it an edge. It lists Blackstone's experience, its disciplined investment process, market insights, and access to credit strategies. They also note they look for companies displaying pricing power. Like many investment funds, this one plans to use leverage or borrowed money to try and boost returns. It's important to know that while leverage can increase gains, it also magnifies losses. Because the fund is managed by Blackstone, they need to be very careful about how they allocate investments. Since Blackstone manages money for lots of different clients, they have a policy to share opportunities fairly, but conflicts of interest are always a risk. Now let's talk about some things you should consider before investing. The report lists some risks to keep in mind. The first big one, you shouldn't expect to get your money back quickly. This isn't like selling a stock. Although the fund offers to buy back shares quarterly, they might not buy back all you want to sell, and needing to make those repurchases could hurt the fund's performance. Also, there's no guarantee they'll actually pay out distributions, and if they do, it might not all be from profits. It could come from selling assets or even borrowing money, which isn't ideal. And a portion of the payments to investors might have to be given back to the management company after, further reducing future distributions. They plan to invest in some lower-rated, riskier debt, often called junk bonds. These can offer higher returns, but they also come with greater chance of default. If you try to get out of the investment within a year, you will have to pay 2% of your holding. The fund also will be borrowing funds, and the interest rate right now is over 1%, with the possibility that this can increase in the future. The fund also discloses information about the people running the show, the trustees and officers. To try and keep expenses in check, the advisor has agreed to waive some of its fees if certain costs get too high, but they can also get reimbursed later if things improve. Of course, like any financial relationship, there are potential conflicts of interest. The document lists several, mainly stemming from Blackstone managing other funds with similar goals, leading to competition for deals. If they cannot find good investments quickly enough, there might be a delay in putting your money to work, which can drag down returns. Uncertainties such as terrorism, international political developments, natural and environmental disasters, epidemics or pandemics, and systemic market dislocations may be highly disruptive to economies and markets. A real risk is that there might not be a ready market for the assets, which are largely private and unlisted. Also, they note the returns are tied to interest rates. Finally, some investment insights come from places that have economic relationships to the fund, creating a conflict of interest that can lead to losses. The fund's strategy leans into riskier debt, where its interests are secondary. There is also the risk of co-investments with regulated funds, impacting the allocation of investment opportunities. And it invests in entities such as insurance companies, and in the event the cedant makes money, the investors do not get a cut of the profits. Last but not least, force majeure events such as war or an outbreak of an infectious disease could have a broader negative impact on the global or local economy. Now, let's put on our thinking caps and look at the big picture here. Strengths: Blackstone's name carries weight and its large AUM gives it access to deals others might miss. The fund's aim to be flexible and adapt to different market conditions also makes it more likely to seek returns in various economic situations. Weaknesses: it's hard to ignore the laundry list of potential conflicts of interest. Because of its relationships with other funds, it might need to make decisions that aren't in the investor's best interests. It also plans to lean into leverage, which is risky for the investors. This all means you have to really trust the management team. Also, the fund's performance is significantly pegged to interest rates, and the fund notes there is a risk of lower value with fluctuating prices. Based on the information, let's try to find some valuation metrics. Currently, the total annual expenses is at 7.04% and fees waived and reimbursed is at 1.20%. You will need to keep the expenses in mind and also the historical trends in the market for context. But please don't take our financial information as financial advice. Be sure to contact your personal advisor. Overall, the fund has a bearish outlook. It may provide a steady income stream with some long-term growth, but you have to be aware of the risks involved and that the fees may take away from profits. Thanks for watching, and if you enjoyed this video and found it helpful, don't forget to like and subscribe.